Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Here's an update on the Bank of America Global Fund Manager Survey. It captures a big bullish shift in investor sentiment, showing the biggest jump in investor optimism since June 2020 and the largest jump in global growth expectations since May of the same year. To dig deeper into the results, into the survey, Elyas Galou of Bank of America Securities joins us now for more. Elyas, welcome to the programme, sir. This is bullish. My first question to you, is it a little bit too bullish?
Hi, John. Look, I mean, this was really a global fund manager survey for the books. As you just said, you know, the one of the biggest rise ever in global growth expectation. Look, this is a series that goes back all the way to 1994, and we saw, in fact, the fifth largest monthly jump in growth expectation in the past 30 years. So, yes, definitely a bullish survey, and for the first time in the past 3 years, positioning is also equally bullish. And I would say that, yes, the bulls are very much in control and have clearly led the charge in the past month.
Elyas, John pointed to this before, this idea that Max Kettner over at HSBC actually sees pretty neutral positioning. And you're talking about pretty bullish positioning. Which is it?
You just need to look at a few different metrics across the Global Fund Manager Survey to just see bullishness is very much spread across the different asset classes. The most important, I would say, is the FMS cash level. Again, a series that goes back all the way to the late 20th century. And that FMS cash level dropped below 4% to 3.9% for the first time since June 2021. We use it as a contrarian indicator when investors are under invested in the market, hence the cash level above 5%. We think that you should buy the market, and when it drops below 4%, we think you should sell the market. And at this stage, our FMS cash rule says that at this juncture, positioning is becoming a headwind. You also look at the cross-asset allocation. Equities allocation rose to net 31% overweight, and that's the largest one-month jump in equity exposure since November 2020. On the other hand, we saw a big decline in bond allocation. In fact, the largest one-month decline in bond allocation that we ever recorded. And the velocity of the rotation was also quite exceptional across markets. EM equities were the big winners, you know, with a 20-point rise in exposure to EM stock allocation. And that's really related to the China stimulus.
That's what I was going to ask. Was it really just the China stimulus that ignited this rotation, this unleashing of truly bullish spirits, or is it a combination of things?
It is definitely the China stimulus, but it's really the combination of three factors. Number one is that the conviction regarding global soft landing remains very much intact. 76% of FMS investors still believe the global economy will experience a soft landing. Note that the balance of risk has shifted to the upside because now the alternative scenario is no more hard landing, it's no landing. The second big reason, Lisa, is related to a big Fed cut expectation. FMS investors expect roughly 160 bips of cuts from the Federal Reserve in the next 12 months. That's pretty much in line with market expectation. And lastly, of course, the China stimulus, which really is seen as a game changer because when you and I met a month ago, China growth expectation had hit a 3-year low. Fast forward to today, they're now the highest they've been since April 23.
If you're one of those contrarians taking on the hard landing or no landing scenario, what does that mean for trades these individuals, these investors want to put on?
Yes, definitely. Who are the contrarians today? Those that would believe hard landing is their main scenario, and also those that would expect a no landing to happen in 2025. But if you are a hard landing believer, then definitely you should go long the 30-year treasury, you should pivot into defensives, you should pivot into cash, and you should really slash your allocation to equities and risk assets in general.
Elyas, I want to get your thoughts on what are investors, given how bullish they are, what are they nervous about?
We always ask in the FMS the main tail risk according to investors, and this month it was a geopolitical conflict. They are still a little bit worried about inflation, but definitely less worried about a US economic hard landing. So yes, geopolitical conflict. And I would say, on the other hand, what would really scare investors is that if central banks do not deliver the big easing that they are expecting. A month ago, we said that investors were nervous bulls. Now they have just become bulls that are leading the charge, and it would definitely still be about geopolitics and about inflation.
Elyas, you can see that bullish shift big time in the fund manager survey. Appreciate an update from you as always, sir. Elyas Galou there of Bank of America Securities. The brilliant Julia Coronado joins us now for more. Julia, welcome back to the programme. It's been far too long. Let's talk about the next jobs report, not the last one. Governor Waller's all come out already and set the bar just a little bit lower, given some of the effects we could get from hurricanes and a strike over at Boeing. How much lower do you think the bar needs to be reset going into November?
Look, I feel like a 25 basis point rate cut by the Fed in November is pretty much, I don't want to say a lock, that's too strong, but the bar is very high to deviate from that. The data is going to be messy. We all know that. It's going to look weaker than it actually is, and it's just going to take some time to sort it out. I think the Fed has seen enough in the backward-looking data that the economy is solid enough that they don't need to worry about it falling off a cliff, but nor is it overheating in a way that they need to maybe consider a pause. So I think we're still 100 basis points at least from any concept of neutral. They don't need to be in a hurry, but nor do they need to be overly cautious or reactive to any inflation print.
Waller did put a number on it. He said it could be around 100K. We could take off 100K from the number. Are you in a similar ballpark with you and the team? Is that what you're looking for?
Yeah, I mean, it's hard to calibrate right now. Honestly, we're still gauging from jobless claims and other reports about how much disruption there's going to be. It's very limited ability to see that in advance. So again, it's just going to take some time, but 100K, I mean, certainly given the Boeing strike, which we can calibrate, that sounds about right. Somewhere in that ballpark. It could be bigger, it could be smaller, and then it'll wash back in the November jobs report. So we're just going to have to see how that sort of nets out over time.
Julia, what are you looking for in retail sales tomorrow? And I say this, especially after bank earnings that demonstrate just how solid consumers are and the ability that they have to actually continue to lever up.
Yeah, lever up is an interesting term. Consumers really aren't borrowing excessively. Debt to income actually in the latest flow of funds report went down. So this is not a consumer that's necessarily relying on debt to finance its spending. I think what we have is a dual consumer sort of increasing divide in the consumer sector, where you've got people that maybe didn't get as big a raise this year. They've got a tailwind from inflation, but they're very budget conscious. We hear that from retailers. So they're spending, but very cautiously. And then we've got the upper end of consumers who are feeling really good because net worth is very high. Financial conditions are easy. And they're maybe spending a little bit more, but they also have the means to do so. So on balance, you've got a median consumer that's probably a little bit more stretched than they were a year ago, maybe a bit more cautious. But on the other hand, you've got high-end consumers that are doing just fine, thank you very much. And that's enough to power the economy forward. So we've had a string of very solid retail sales reports. There's no signs that we're of some sort of imminent collapse. I think expectations for the holiday season are that it'll be fine, not a blowout, not a disaster. So I think the economy is kind of in a good, solid zone.
Which is certainly what we're hearing reflected by a number of Fed members who want to keep it that way and want to keep cutting rates in tandem with inflation coming down, which really brings me to this question of why do you think that people are so confident about the path of disinflation now versus, say, a month ago? What has changed to make the prospect of inflation remaining at this level or actually to go higher? Why is that now off the table?
I wouldn't say it's off the table. I would just say the chances of that keep going down. The composition of inflation, and I think President Daley noted this yesterday, one area that's really improved this year is supercore inflation, particularly in the Fed's preferred PCE measure, really has kind of come off that stickiness. It was in the sticky zone. It wasn't clear how quickly that would moderate. We are seeing progress there. We are seeing progress gradually in the shelter component and housing inflation. So just the composition of inflation looks a lot better, a lot healthier, a lot more like it did before the pandemic. And so the risks of it getting stuck too high are just going down. And then if you think about things like commodity prices, look at how many global shocks we are absorbing, one after another. And yet commodity prices really, it's the dog that hasn't barked this year. It's gone up and it's gone down, but really we're still in the same zone on energy prices we've been all year. So yes, there's risks, always risks. But I think a cooling China has really taken the edge off of what we might have otherwise seen in terms of input costs coming through from those global shocks.
Julia, we are less than 4 weeks, about 3 weeks away from the U.S. election. And a big question is, the U.S. is on solid footing, but how different are the scenarios in terms of the policy frameworks after November 5th? What are you looking for? How different could these two economic scenarios be according to your models?
Yeah, it's an unusual divide for, most presidential elections. It's a little bit around the edges, right? A little bit more tax cuts versus spending. We're talking about a very different scenario in a Trump 2.0. A Trump 2.0 wouldn't look like a Trump 1.0. The staffing wouldn't be the same. The blueprint for policy is certainly a lot more extreme than what he was able to do in his first term. I see it as a pretty disruptive scenario. His plan is to invoke a global trade war from the get-go and to be, turn off that flow of immigration that's been quite a tailwind for the macro economy. And not only turn off the flow of new immigrants, but even mass deportation of current immigrants. And that really has been the saving grace of the U.S. labor market. So under a Harris administration, I think we keep rolling along. It's pretty much status quo. The composition of Congress is going to matter a lot under either scenario. But I would say, the Trump 2.0 scenario is a much more uncertain scenario, much more disruptive, not just for the U.S., but for the global economy.
Julia, appreciate your view. It's good to catch up. Julia Coronado there of Macropolicy Perspectives. We begin this hour with stocks looking for a firmer footing as earnings from ASML spook tech investors. The manufacturer of the world's most advanced chip maker machines booking only about half the orders analysts had expected and cutting its guidance for the year ahead. Joining us now to discuss is Keith Lerner of Truist. Keith, welcome to the program, sir. This market was spooked yesterday by that one name and by those earnings. How spooked were you?
Well, first, great to be with you. I don't know that I'm spooked. I think, listen, it was a bad print as far as earnings. But, this market keeps changing narratives. You think about the broader market. One month we're growing too slow. We're heading to a recession for the U.S. Next month, we're growing too strong. And then with the chips, it's kind of similar, right? I mean, about 2 weeks ago, we were talking about Micron, talking about how much demand there was for memory and upgrading their forecast, and the stock's jumping. And then also context-wise, NVIDIA, since early September, that kind of after that sell-off, was up over 30%. Semiconductors up over 20%. And then you have this print, and we all know now that ASML's biggest customer is China. So listen, I don't want to be complacent about it, but I'm also trying to put it in context. And I think longer term, especially on the AI side, there's still a lot of demand. Don't forget, maybe one more comment is that, a couple of weeks ago, we were all talking about Elon Musk and Larry Ellison fighting over NVIDIA chips. So again, just some context.
Keith, you're right.
In order.
NVIDIA themselves have talked about massive demand, and I think you're right to identify China, because speaking to that is LVMH. LVMH earnings, big downside surprise there. Sales not great, particularly in China. So Keith, as people start to get excited about investing in the rest of the world, when you think about where your bias is, and I'm going through some of the details of your positioning, overweight stocks, underweight cash, and you maintain a bias to large caps. Are those large caps in America?
Yes, I mean, we've been Team USA, talked about this on this program for several years now, Jonathan, so we're still there. I will say on the margin, we're still, emerging markets, we moved out of emerging markets completely over the last couple of years, and that's been the right move. Emerging markets have underperformed by a fair 50%. We upgraded emerging markets one notch here recently, still not overweight, but I will say, I mean, if you look at the rhetoric out of China, I think that they're going to still continue to support that stock market. It got overheated. They don't want it that overheated. So you went up 50%. Now you're down about 15%. I think we're going to get more news, and I think that they will support that market. So on the margin, I think a little bit better. But again, bigger picture, we are still Team USA. I'm just making a reference to a subtle change.
Keith, we were talking earlier about the Bank of America Fund Manager Survey and the 3 pillars that were really supporting the incredible bullishness that has seeped into the market for the past few weeks. One of those prongs was the China stimulus, and yet there's a really concrete question here about how much any kind of stimulus will even trickle into the global market versus just stay in China. How much can that be a pillar of optimism for U.S. stocks?
Well, we didn't need, we haven't needed the growth there for the U.S. markets to be in this great bull market. So I think this recent stimulus is a defense move by the government. But I do think it is the most massive stimulus we've seen since, the pandemic. And I will say, I think people are looking for shifts already. Like the stimulus acts with a lag mostly. So I don't think you're going to see it overnight. And I don't think there's going to be this big global stimulus that's going to help, Europe to the same extent. I think it's much more focused on stabilizing the local economy, helping the local stock market as well. So I think when people think about the stimulus, I don't think it's the stimulus that we've been accustomed to over the last 2 decades for China and the way that seeps into the rest of the globe.
In the meantime, Keith, we were talking about some of the swings that we've seen overnight, not just in ASML, but also in NVIDIA. And the fact that you're seeing a $160 billion move on any given day, not necessarily on anything related to that specific business, gives a sense of how jumpy and volatile specific names have been. How do you play that, especially if you have a bullish take on it? At what point does it become concerning? At what point is it a buying opportunity for you?
Yeah, so speaking specifically to tech, I mean, we were overweight tech most of the year. We downgraded in June after it got extended, and then in August on the pullback, we added back to it. I would say so. We're still positive on tech. We still don't think we're in an AI bubble. And then with semiconductors specifically, like I said, they had a big move in a short period of time. So we're staying with that primary trend, which we think is up, as long as the earnings continue to support, meaning we focus a lot on the forward earning estimates for the broader sector and also the industry. So far, they are still stronger than the overall market. Where we would change our tune is if we see that roll over. We haven't seen it at this point, and I don't think ASML is enough to change it. But again, we'll keep an open mind as we head deep into this earnings season.
This bullishness just hit a bit of a wall in the last 24 hours, and I have to say I've identified a lot of bullishness just around the table from some of the guests we've been speaking to, Lisa. You hear it from Jonathan Galou over at UBS. It's a move to the upside in terms of their outlook, their price targets. This is from the Bank of America Fund Manager Survey. We were sharing it just yesterday on this program. The biggest jump in investor optimism since June 2020 on Fed cuts. The biggest jump in global growth expectations since May 2020. The biggest jump in global equity allocation since June 2020. Keith, this came from Jonathan Krinsky over at BTIG. Fear of downside has left the building, and fear of missing upside is front and center. Yet we think now is the time to look tactically at downside risk into month end. Keith, I know it's a very short time horizon, but going into the end of the month and particularly into November, how are you thinking about how to position?
Yeah, so I think time frames really do matter. Like most of our clients aren't trading for the next 2 weeks, but I will say I agree that sentiment is a bit of a risk here short term because markets are all about how things come in relative to expectations. Those expectations have increased. You're also seeing that in the put to call ratios, which are at the lowest levels since July. I will mention that Global Fund Survey. June of 2020 ultimately wasn't such a bad time to invest. On a short term basis, you had a 4 or 5% pullback around that period. But again, remember, that was the early stages of a bull market. I'm not saying we're the early stage of this bull market. So I think the way I would think about it is on a short-term basis, maybe a little bit extended, maybe you get at least one or two more hiccups around the election. But I would think that would be contained within that 5, maybe to 10% max side, and keep focus on the underlying trend, which is positive. I'll also say in an election year, by the way, this is the strongest election year we've seen for the stock market since the 1950s. Normally, if you've been up more than 10% heading into the fourth quarter, you've been up every time. Small sample was only 7 times, so I just want to be clear. So I would just say stick with the primary trend, and we get some hiccups along the way. I would use that as an opportunity to add.
How much, Keith, does the gain of stocks come on the pain of bonds at a time where there's sort of an inflationary question mark underpinning a lot of this, whether we're in a structurally higher inflation kind of regime? How much are you betting on that in terms of the allocation of stocks really is because bonds look less appealing to you?
Well, bonds have actually acted pretty well this year. They've been acting more like a diversifier. I think for the stock market to do well is really bonds could be stable, because what we've seen recently is, our work suggested that, fair values are right around where we are in the 10-year Treasury right now. So I think there's still some value in bonds from a diversification standpoint. There's still decent income there. But, where we would get more concerned is if we started to see yields move back up, say above 450, credit spreads start moving out as well. That would be the concern. But where they are today, I don't think is a major problem. And I still say we still see relative value in the equity market, just because if the economy stays more resilient, that should lead to corporate profits continue to move up. And that's been the most stable thing we've seen in this market, right? All the narratives have shifted. The earning trends for corporate America have been the most stable part of this market.
Keith, I have to say there has been a lot of bullishness around this table, and it has been growing over the past few weeks. This from Barry Bannister, just to give a dose of cold water and some contrarian thought over at Stifel, basically saying that the S&P could gain another 10% this year, but then will plunge by some 40% by next year, just simply because, as he said, there is a cost to so much winning that basically when you take a look at valuations, they're starting to look pretty heady. At what point do you get concerned just about valuations in and of themselves?
Yeah, listen, I think Barry's a tremendous analyst. I respect his work. We're not in that camp, to be frank. I mean, when we look at, like, say, 10-year rolling returns or 5-year rolling returns, not extreme, maybe more on a short term, somewhat extreme. Valuations are a tough thing, right? Because valuations have changed over time because the tech sector is now, 30% of the market. If you look back to 1990, the S&P tech sector was about 6%, right? And that's where the valuations have really expanded. On the same token, that's where the cash flow and that's where the profit margins are. So in our view, as long as the economy continues to move forward, corporate profits move forward, we can sustain somewhat of higher valuations. I think the way to think about valuations is it likely caps the upside. And in some of our long-term work, we actually think long-term returns are actually below average. On a short-term basis, I think it's really difficult to use valuation to say where the market's going to be, at least in the short term, as far as the next 6 to 12 months.
Keith, appreciate it. Keith Lerner of Truist.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.